Hi, everybody. Hi, everybody. Thanks for joining us again on this Tuesday. Appreciate you taking taking the time out of your busy schedule to be with us. This is part two of our educational series on investing in real estate syndications. And today we're going to be focused on evaluating the sponsor and the deal. So basically, we're going to try to give you some basic information on how you can evaluate whether the syndication investment is appropriate. A little bit about me. I am Joseph Fang, the Director of Investor Relations with Break of Day Capital. We are a value-add multifamily operator focused in the Southwest, with primarily concentrated in the high-growth markets in Arizona. My professional background is in the investment management business, having worked at a hedge fund in New York City, and then later on for a large fund manager in Los Angeles. Over the years, my wife and I have accumulated a portfolio of real estate ranging from single family residential to small multifamily, and then even some Airbnbs. We experienced going into the 2005-2006 real estate bubble, and certainly benefited tremendously as we started in our real estate investing career, I guess. But we also certainly saw, when things fell off the other side, having survived and the 2008 great financial crisis, the pain and suffering and the despair that went through, and having that experience has proven to be invaluable as we evaluate investments today. So having been landlords and operators ourselves for several years, we certainly, let's just say, have become tired landlords. And being investors in California, it's not exactly a landlord-friendly state, and dealing with the regulatory issues, eviction, difficulty with tenant evictions, when they're not paying, and rent control and stuff like that. It's definitely a very challenging environment to operate in. So over time, we were looking to continue to be exposed to real estate, but wanting to diversify out of state, in different markets. And we were evaluating the different ways to diversify, and we were looking at doing 1031 exchanges into other properties. We were looking at exchanges into DSTs. We were looking at turnkey rentals, and then and finally just learned about regular syndications. And that's the route that we decided to go with for the best combination of risk reward. And so since 2017, my wife and I have been investing in a variety of commercial real estate syndications, and I think we've done just over 50 deals at this point, and across different asset types, different geographic regions with different operators, and have certainly had very favorable experience for the most part. There's definitely a few losers in there as well, and so I'm happy to share that experience with you later on. And so today, I am, working as a director of investor relations with Break of Day Capital. And my goal, my why, the reason why I'm here today is because I want to share with you my investment experience, not only as a direct real estate owner, but also my experience, investing in these types of syndications, and kind of, I can help you in your journey to learning about investing in syndications and how that might help with your wealth creation, wealth preservation, and hopefully obtain your financial goals. And so today we're going to focus on evaluating the sponsor and then the deal. So last week, we talked about what a real estate syndication is. And today, we're going to take a deep dive and learn how to evaluate the sponsor and then the deal itself. So I mean, just like with everything, when if you're hiring a contractor, if you're let's say you're dating, for potential dating somebody to figure out if they're a great fit for a lifetime partner, right? Or maybe you need uh medical procedure, and so you're evaluating the doctor that's going to be performing the work on you, right? So you're probably going to want to it's very logical to want to work with somebody that like and can trust, right? And so how do you do that, right? How do you until you really get to know somebody really, really well, through the experience that you'll have with them, you just don't know for sure yet, right? And so how do you at least assess them, before you really get to know them well, right? Well, the biggest thing is their track record, right? As you evaluate a sponsorship team, really, you have to just look and see what they have done in the past, right? That's the best judgment that you can have until you get to know them very well yourself. And so what are the things that you can look at? Well, look and see what their portfolio looks like, right? Look at their assets under management. How many deals do they have? How many deals have they done? Look at their operational history. How long have they been around? Did they start last year, or have they been around for several years? This is one of my own personal favorites. Maybe I'm not sure how to say it, but my own personal bias. Let's put it that way. Is do they have niche expertise? Meaning that, for example, break of day, we are focused in a particular asset type, which is multifamily, and we're particularly focused in one strategy, which is the value add. And then we're only in a couple of markets in Arizona, and we're very focused on those markets, right? And so we're like a specialist in that area, in that asset type and that investment strategy. And we're not pivoting to doing car washes. We're not looking at industrial. We're not trying to go to another market. And so the point I'm trying to make is that it's a market, it's a strategy that we have done a lot and continue to, and it's something that we're going to continue doing. And so that means that we have the experience to keep, doing this kind of, to do this type of investment, right? And then you want to see, preferably a sponsor who has gone through a deep market cycle. For example, if you have experience going through the great financial crisis, that's extremely helpful, right? But the truth be told, a lot of the operators that did survive the 2008 crash, have now graduated to becoming a private equity firm. Maybe they're raising large amounts of money, and their primary client base is institutional or ultra high net worth individuals, where the minimum investment might be $250,000 or $1 million or even $5 million. Just something that us retail investors couldn't necessarily get into. But that's okay, and there's a lot of new syndicators out there as well. But if an operator has experience, owning a business, running a business, going through the downturn, that certainly is very helpful as well, because a lot of those skills of running a business can certainly be transferred. It's transferable. Those skills are transferable into the multifamily business, right? Because ultimately you're collecting revenue, right? You're collecting rents, and then you have payroll, you have expenses, and then ultimately you have debt that you need to service, right? So it's very typical of a business, of a typical business, right? And also having operational experience going through just a variety of challenges, whether it's economic or at the property level, dealing with rough tenant base, or maybe with property managers that are not executing to your standards, or whatever other issues. Like, for example, in just the last few years, we've had to deal with COVID, the way that properties, have to be handled, the cleaning process, dealing with the eviction and rent moratoriums. And then also just recently, with this rapidly rising interest rate environment, that's putting a lot of pressure on operators' ability to service debt. Just being able to operate through these challenges, is also extremely helpful in the abilities of the operator. And then finally, you want to see how many deals that they've gone full cycle. It's great, that they bought a deal and then they can successfully operate a deal. But where the rubber meets the road is, can they sell the deal, and what were the actual results versus their projections? Were they below, were they above? And then how much of the returns actually came from the market appreciation, and how much of it is actually did it actually come from the work that the operator put in, the sort of the value add business plan, right? How much of that was derived from the ability to push rents, to increase operational efficiencies, and then ultimately, increasing the net operating income, and then forcing the appreciation, from the work that was performed, rather than just a market that, is in the path of progress, and that it became more desirable, and hence the property values, went up over time. So with that in mind, don't be afraid to ask the sponsor tough questions. Ask them if they ever declared bankruptcy, if they ever lost property or investors' money, issue capital calls, pause distributions, perform below expectations. These things are, as we mentioned in the previous webinar, a lot of stuff are out of our control, and it's just really just who the best operators are well equipped to handle adversity, right? So if, again, I mentioned this before, if a sponsor tells you that they've never really had any issues, that's just either they're inexperienced, or they haven't done enough, or they're just, are not being transparent, right? So a lot of stuff can go wrong. It's just a matter how it's being dealt with. Okay. And then something else that you want to look into is look at the management team. Is this somebody, is this a sponsorship team that is 100% dedicated, to the mission? Are they part-time? Is this somebody that still has a W-2 job and is like trying to transition into, real estate syndications and doing this part-time? So you really want to know who you're dealing with, and you want to look and see what the team members did in the past. Do they have previous experience in syndications, and if not, do those skills can they be transferred to the multifamily syndication business, right? So at least you want to see that there's synergy there. And then you also want to see what roles they play. There are certain positions in the management team that's critical to the long-term success of the syndication, right? So you want to see, ideally, you want to see dedicated roles in the dedicated employees in the asset management role. Maybe the acquisitions. You kind of want to see that there's strong back off support. And maybe somebody like me, who's focused on communicating with investors, keeping them abreast of everything that's going on, that kind of stuff, right? And finally, you kind of want to know about the financial viability of the company, right? I mean, they should be profitable. Sponsorship team does charge asset management fee, right? So that should be more than adequate to pay to keep the lights on, to pay the employees to perform professional work, and for their dedication, right? You want to see that they have corporate liquidity, basically, as much as we can project any unforeseen, or I should say, as much as we can project any type of issues that may pop up. There are certainly things that are just that come out unexpected, right? And the best way to deal with those kind of situations is just make sure you have plenty of liquidity to be able to backstop, some of these issues. And then, of course, you want to see that the company, has a strong balance sheet. For you to qualify for these large loans, you have to have the net worth and liquidity, right? And so, you want to see that the principals are they have their skin in the game, right? And so a good tip that I would offer you is that you basically want to see a full-time sponsorship team with dedicated professionals in key positions and a strong balance sheet to be able to handle any unexpected adverse conditions, okay? And certainly, in the last 6 years I've been investing passively with other operators, having these attributes definitely increases the likelihood of success. And then communication. This is a really big deal. I've talked to many investors, and then being a passive investor myself, this is something that I'm also very focused on. I can't tell you how many people I've spoken to that that will not invest with the same sponsor again, despite producing good results, because they're just not really good at communication, right? And so it really goes a long way to be proactive and transparent and reporting, both good news and bad news, kind of making sure that the investor is aware of everything that's going on, and even letting them know that when there are issues, and there will be issues, that they're being properly dealt with, and if something's not working, what are we doing? What adjustments are we making to pivot and try to make it work with something else, right? So keeping investors updated is extremely important. And something that I personally like to see are, whether it's monthly or quarterly, just having consistent reporting, where the operator might give you some updates on executing the business plan, and then how that is translating into key performance indicators, and how does that compare? What do the actual KPIs, how do they compare to the projected, right? So you want to see that the value add, the work that's being done, and how is that translating into figures, right? And so you want to be able to gauge how well the operator is doing, right? And so what you can do is, so let's say this is the first time that you're considering investing with a sponsor, you can go and ask them for past sample reports to kind of see, like, how good their reporting is, and then you'll also want to see a sponsor, an experienced sponsor, certainly somebody who's very serious about this business, should have an investor portal where various important documents are kept, such as like the PPM, the operating agreement, your subscription agreement, the year-end K1s, that so that you can always log in and be able to retrieve these documents as needed, right? And then finally, as you're evaluating the sponsor, you're probably emailing back and forth, and maybe scheduling some calls, just kind of gauge them on how quickly they're, how responsive they are, right? Because if you think about it, if they're already a bad communicator, in the beginning, like, imagine when they have your money, like, then they're not really even motivated, to want to, to talk to you then, right? So just think about that. So, as you're getting to know the sponsor and getting a feel, don't just believe everything they tell you. You might like them, and you have a really fuzzy feeling, and you want to you're ready to invest, just take a step back, don't fall into FOMO, do some independent verification, right? Look at their, these days, I mean, so much of what we do is on social media, right? And if somebody, has done something wrong, you're going to find out about it very quickly. This is a pretty, I mean, it's a big industry, but, almost everybody knows each other. So if something, goes wrong, you're going to find out about it very quickly. So go to social media, look at the company's online presence, look at their website, check out their LinkedIn profile, look and see, and go and see if the sponsor has been featured on anyone's podcast, or maybe they run one themselves, and just kind of get a feel, for how it is that they interact with people. Are they respectful? Do they do they have, do they express, like, do they have evidence, are they showing evidence of integrity and humility and integrity? Or are they just out there, talking crap about other people, or making outrageous claims on how awesome they are, right? Those are character flaws, right? And if that's how they portray themselves, that's probably a red flag, right? You can also join various passive investor groups and just ask around. You never know, somebody might have already invested with them, and can give you, their experience. And then if you want, you can also run background checks, and look for any evidence of criminal history, any, regulatory violations, any liens, if they have any issues with credit. So these will all be, potential red flags, or actually just outright red flags, right? And that's another way. There's various sites that you can go to. I think TLO.com is one of them. You can, when you're, let's say, when you're looking for a general contractor to do work, right? I mean, it's very typical to ask for referrals, right? So you can do the same thing with operators. You can ask them to provide you with referrals from, past, present, investors. You can actually ask for references from the professionals that they work with, such as their syndication attorney, maybe their property management company, or maybe even some of the vendors that they work with, right? Just to kind of get a feel for how they interact, how they treat their partners. And then, if at all possible, try to meet them in person. When I first started out investing in syndication, I actually drove, my wife and I actually drove all over the country, meeting sponsors in person, getting that gut feel, and even checking out a lot of these properties in person, just to, really get to know what it is that, we're investing in, and who are we investing with, right? So that's ideally, if you can meet with them, that would be the best. And so I'm going to offer you another tip here. An ethical sponsor should be just as concerned about you and your financial goals and risk tolerance, instead of just always trying to pitch you deals, the hard sell, and, always, if they seem like they're more concerned about, having you invest in their deal without even getting to know you, and understanding your risk tolerance, and learning about your financial goals, and whether this is even appropriate, if they're just interested in, getting their deal funded, and not even worry about doing what's right by the investor, and it's just, that's a pretty big red flag there. Okay, so it goes without saying that the sponsor is probably the most important. These are people that you're going to be, think of it as a marriage, right? You're going to be working with them. You're going to be investing with them. They're going to be handling your investment for several years. And so, if you get the sponsorship team right, usually the deal will take care of itself. If you think about it, a quality sponsor, they've got a lot of skin in the game, right? They have their own money in the deal. they have, they're signing on the loan, and they're not, they're not doing this for charity, right? They want to make, they want to make their profit split. So they're not gonna go buy a bad deal, right? And so if you're working with a quality sponsor, most likely, the deal would also be, it's likely to be a favorable investment. So now that we're going to look at the deal, so now we're going to look at the deal, right? The next most important thing after the sponsor is the market, right? How many times have you heard location, 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 as it relates to real estate investing, right? So even before we talk about the deal itself, the asset itself, you want to understand, the market, right? Where is it located and why? Why that market, right? And so how do you determine what is an appropriate market? And so in general, whether the business strategy is, you're investing in a stabilized yield asset, or if you're doing value add, or if you're doing a ground up development, regardless, it's much better. You have a much higher chance of success executing these strategies if you have the win at your back, right? If you're in a market with strong fundamentals, it definitely gives you more leeway. If something, not everything's going to happen according to plan, but if you have the win at your back, there's a much higher probability of success, right? So it's really important that you pick the right markets to go in. What does a right market look like, right? So you want to see, if you look at the bullet points, and these are some of the typical attributes, right? You want the MSA size to be of a certain size, right? And MSA stands for Metropolitan Statistical Area. So think of it like this: the Greater Phoenix MSA is over 5 million people, right? But we could be investing in various submarkets, like we could be in Peoria, Glendale, or Tempe, right? And so those submarkets will have, it has its own individual, demographics, but we're talking about the greater overall MSA, right? And so you want to be in markets that are adequately sized, and we feel that the smallest MSA to be in is probably like 1 million, and that's like a Tucson. We just want to make sure that there's plenty of you don't want to be in a market that's too small, because it's just not as attractive for employers and people that want to move there. And you probably don't necessarily have the proper infrastructure in place, as we mentioned here in the bullet points. Really, you really want to be in that path of progress. You want markets that are growing, and so and they tend to be in business and landlord friendly states, right? And that's why employers are moving there, and then people tend to move where the jobs are, right? And so as more people move there, there's going to be greater economic activity, more money, more velocity of money being sloshed around. So eventually that will lead to income growth, and then ultimately rent growth, and then appreciation of the properties that we invest in, right? And some of the other characteristics that are very important is you want to have a diverse employer base, preferably across many different industries, so that if there was ever any downturn in any one of the one or two of the industries, the overall job market is not impacted. Because if you think about it, one of the reasons why people move is because maybe a company has packed up and left, and they have no choice but to move. There was a time that Toyota had a big presence in Southern California, and a lot of people moved because when Toyota moved to Dallas, right? So something like that. Look for large hospitals, the presence of blue chip companies like Costco and Trader Joe's. These companies, they tend to spend a lot of research in the area that they want to set foot in, and so if they're there, chances are they have already, they've done the homework for you, that there's definitely long-term growth viability, in this market. Something else to be aware of, there's kind of a sweet spot for rentals, right? If you look at the median income, right, you don't want the income to be so high that people can go and buy houses, right, and not be become house owners and not become renters, right? And then but you also don't want the median income to be so low that it can't support the rent levels that you're trying to achieve. And then in relation to that, it's ideal that you see home prices, the median home prices are on the higher side, because then, people who want to live in that area, wouldn't be able to get into those homes, and then, we'll have to, rent, which is your customer base, right? And then, some of the other attributes that are very favorable, affordable costs of living, and that kind of goes with a lot of times that goes with places that are business and landlord friendly, right? And that's why companies move there in the first place, is because the cost of doing business, the cost of living is going to be on the lower side. Crime statistics is very important. When you buy a nice property in the hood, it's very difficult to manage, and it's something that we avoid. It's just we don't want to put our investors' capital at any additional risk of being in an area that we can't control. Okay, school ratings is important. A lot of people stay in the area because they want to stay within that school system. So provided that the school ratings are decent, that's important. The absorption rate. When you have a growth market, it's going to get the attention of developers, right? So they're going to come in and they're going to want to build more units, right? And so sometimes they overbuild in a short amount of time, and that could, because if you have a lot of supply coming online and not enough demand yet, you may face short-term occupancy issues, but again, in the long run, if you're in the growth market, the absorption rate shouldn't be a problem. So the tip that I want to offer you here is that you really want to, as you evaluate syndication deals, the market is very important, and you want to be in growth markets with strong fundamentals, and really gives you the best chance at executing the business strategy, whether it's value add or stabilized development. In fact, I would even go as far as saying that if you're in a stagnant market or a market that is losing population, I would almost tell you that there's probably it's probably going to be very difficult to even push rents, and you might even have occupancy issues. And I'm speaking from personal experience, investing in a tertiary market with no growth. So finally, now that you have a better understanding of the market, let's talk about the deal itself now. So this is actually a little bit easier to evaluate. The most important thing here is just understanding what the investment strategy is. Like, what's this deal all about? Is it a stabilized yield where you're kind of more focused on cash flowing? The investor is actually banking on more cash flow upfront, and then maybe less appreciation on the back end. This is a deal that wouldn't have much value add opportunity, where you're kind of just subject to the market, market growth, the market level, I should say market rate, rent growth, right? Could just be a couple of percent, 2-3% a year. And so, or maybe you're looking for, something where maybe you're less concerned about cash flow, and you really want the highest potential upside. And so maybe a ground up development deal is more appropriate at this time for you. And so you're looking for something that maybe doesn't cash flow for 2-3 years, and then you get a nice big equity pop at the end, right? So that's just a really, the idea here is just really dependent on how the strategy fits in your total portfolio, it's going to vary person by person, right? As you evaluate the deal, now you want to kind of look at the business plan, like what it is that they're doing, and again, whether that's appropriate for your how it fits in your total portfolio. Have they, let's say it's a value add strategy, like have they budgeted enough for capex? Do they, you should be able to, the sponsor should be able to show you in the investment deck the source and use of funds, right? And so how much are they raising for capital improvements? And then each of the major items should have a budget, so you can kind of evaluate whether they have properly budgeted for the right amounts, right? Like a typical paint job is like $100,000, and if they put down 20, that would be a red flag, right? So you kind of want to make sure they've budgeted the right amount of money. Something, this is getting a little bit into the weeds here, but there's something called the development spread and yield on cost, and it's this idea that when you let's say you're doing a value add strategy, the going in cap rate is a little bit less important, because when you're making improvements, you're expending, you're investing capex dollars to make improvements, and you're going to be able to bring rents closer to the market. And so there's a metric called yield on cost, which is basically how you're going to improve on the property, so that your going in cap rate might be, it might be low, but after you've stabilized the property, the stabilized cap rate, which is called yield on cost, looks a lot more favorable. And then the difference between that yield on cost and the development spread, or I'm sorry, I should say the yield on cost and then the going in cap rate, is a development spread. So you can kind of measure when you when a sponsor does a value add strategy, how much percentage is in that development spread. And obviously the higher the number, the better, right? And then something that you want to make sure is that when the sponsor shows you what market rent should be, if you were to bring if you were to make the improvements, they should be able to show you comps that where other operators in the same area have achieved a certain level of rents because of the improvements that they made. So there should be some evidence that that this strategy is viable, right? But where the trick is if an unscrupulous operator compares the business plan, the value add strategy, to like a Class A property, which is inappropriate, right? Because if you're taking a B and C and making improvements, you should be comparing to other B and C properties that have the similar improvements, not a luxury Class A property. So just be aware of that. The operator can they do something called secret shopping, where they actually pretend to be investor or to be a tenant and go check out these properties, and then be able to see firsthand what improvements are made and what kind of rents are being achieved, right? And then the passive investor can also look this up themselves and or potentially even visit the properties and shopping the comps. You'll want to see that again, going back to the market, you want the property to have adequate infrastructure in place, proximity to major highways, retail, grocery, restaurants. Nobody wants to live in a place that's like kind of out of the way and hard to get to, and very little visibility, right? They want, people like convenience, right? So you want access to all the major attractions. So that's something that's something to keep an eye out on. And then debt structure. This is probably one of the most important. And in fact, right now, that's something that is making the news line, making headline news every single day about operators not being able to service their debt because they put on floating rate debt with no rate cap. So evaluate how they structure the debt. Is it appropriate for the business strategy? For example, if you have a stabilized asset where you just collect, you're just banking on cash flow, maybe putting on long-term fixed rate debt would be okay, would be appropriate because you're not expecting to exit anytime soon. And whereas, if you're doing a value add strategy where you're going to be able to increase the property value significantly in 2-3 years, you may not necessarily want to be like in a 12-year agency fixed debt because, there's pros and cons to every type of debt structure, right? These long-term fixed debt carry very steep prepayment penalties where that it could be so onerous that it might actually wreck your expected returns. So, it may not be appropriate. Whereas, a floating rate debt that have, maybe just a 12-month or 18-month lockout and with no prepayment penalties or very light, prepayment penalties, fees, it could be appropriate as long as it's structured properly, right? When you use floating rate debt, you almost want to, you almost always, I don't even think there's any exceptions. You really need to have a rate cap, just, as an example. And then, because, we specialize in the value add space. One of the things that we've learned, and, as a sake of being conservative, is that, you really need to have proper reserves and even excess reserves just to back up any potential issues that you didn't, you weren't able to forecast, right? These older properties, things are going to break, whether it's the roof, the chillers, plumbing, and even if they're in good shape during due diligence, when we do the property inspection, we're still going to want to budget for those things breaking down the road, right? So just something to be aware of. And then, and now we're getting, down into the nitty gritty here. So as you look at the operators pro forma, their underwriting, you want to pay attention to their assumptions, right? What are they projecting? Like, you make sure that you understand what their assumptions are for rent growth, the expense ratios, and are they taking into consideration the economic occupancy? For example, you might have a physical occupancy projection of like 5%, right? But then, as you're executing your value add, you're going to have turnover. You're going to have tenants that don't pay. You're going to have down units. You're going to have a variety of units that, although may be occupied, but people are not paying for whatever the reason. So we call that economic occupancy. So you want to see that the operator has built that into their model, right? So at least that they're aware. The more sophisticated operators will build that into their model. So you want to see that. Something that of a red flag is like, if you're seeing huge rent growth projected in the pro forma, in the underwriting, that's it could happen, but a conservative underwrite or conservative sponsor wouldn't necessarily build that into the model. Now, if it happens, great, that's additional upside, but you don't necessarily want to see them projecting these huge rent growth. And then, make sure that the expenses are properly accounted for. Typically these large multifamily, you could see expense ratios anywhere between 35 to upwards of 45, 50%, just depending on the location. And I think over time, when you've seen enough of these deals, you'll get a feel for what's the appropriate expense ratio. And if you don't know, just ask the operator to explain to you why they think that this is appropriate, right? Just when in doubt, ask questions, and if they don't give you a really good answer, walk away, right? There's plenty of good operators out there. If you're uncomfortable in any way, just walk away. Something that has become a big issue recently, and again, this is a good operator would always take into consideration these things anyway. But insurance costs, have skyrocketed in different parts of the country, and to the point where it's really causing a cash flow crunch for many operators. And also property taxes. Certain states are very aggressive in reassessing property value, and then the tax that comes with that, and that's also really hurting some of the lesser experienced operators who did not properly project, build in these types of expenses properly. You want to know if the property is in a flood zone. That's going to require additional insurance coverage, and and potentially have more operational challenges. If there's a flood, so just be aware that could be a big issue. In-place cap rate, reversion cap rate. The in-place cap rate is a little bit less critical. Again, I mentioned earlier that if you're a value add operator, to the extent that they can improve the operations, and then that yield on cost, it might be a better gauge than the going in cap rate. However, where some operators can play games is in the reversion cap rate, which is what the assumptions are when they go and sell the property, right? So the lower the cap rate, the higher the richly valued the property is expected to be, right? And the reason why cap rates compress is because you're in a growth market, and a lot of people want to invest in the growth market, and so they're willing to pay more for that stream of cash flow. So it doesn't mean that cap rates won't compress later on, in the future, in a growth market, but you certainly don't want to, a conservative operator certainly probably would not want to build that into the portfolio, into their modeling. You kind of want to see cap rates that are, at least at the long-term average, or maybe even higher, would be ideal. And then you also want to see how the operator thinks about risk, right? And these are some of the metrics that either they will show you, or you can certainly ask about them. You want to know where the break-even occupancy is, the debt to service, the debt to service coverage ratio, to see how much of the property can be empty and still be able to service the debt, and kind of carry the expenses, so that they're not having to issue capital calls, or and just being aware of how much the property can go under duress, before more money is needed, right? You also want to see additional stress testing, sensitivity analysis, and that could be like a grid where the operator shows you what happens to the investor's expected return as the variables of occupancy, cap rate, rent growth. There's various metrics that they could put on. As those things fluctuate, how does that impact the investor's expected return, right? So like you could potentially see a sensitivity analysis where, the occupancy could be like 15%, which is, pretty high, right? Or the cap rate could be like at 7%, and the projected IRR is still like single digits, right? And that's actually a pretty good sign that, if you have a very unfavorable condition, you're still going to walk away with, a positive return, right? And that's a pretty good thing. So, a good operators will definitely do those, be able to perform those things. Either they will include it in the investor deck, or they certainly will do it internally. So you can just ask them about it if you don't see it. Okay, and finally, fees and splits, right? So I'm not gonna talk about this much today. Next week, same time, same channel, we're gonna take a deeper dive into the fees that are involved, and then the profit splits that are appropriate, that we think is appropriate to the investors. So we'll take a deeper dive into that next week. Just one thing I want to note here is that of all the things that we just talked about, a lot of that information is going to be in the investor pitch deck, and so just make sure that you read through the legal documents, the private placement memorandum, the operating agreement. Make sure that what's spelled out in those documents are consistent with what you're seeing in the investor deck, right? Because at the end of the day, that's what matters. This is what protects you, in case there are any issues, right? It's the legal documents, not what's in the pitch deck. So just make sure that you go through them, and make sure that the terms and making sure that what you believe is what you believe about the deal is accurately reflected. And then just finally, the tip that I can offer you here is just make sure that the projected returns, are realistic, reasonable, and it's based on realistic underwriting. Every operator is gonna tell you that they're conservative, but ask them, why? Why do you believe that your underwriting is conservative, and let them explain it. Okay. And again, we'll go over this next week, but you'll want a sponsor that prioritizes, returning the investor's capital and getting their share of the profits. They're hitting a certain hurdle rate before the operator participates in the profit sharing. Okay. So we'll save that for next week.